Ladies and gentlemen, good day and welcome to the Q4 and FY24 results conference call of Gulf Oil Lubricants of India, hosted by Emkay Global Financial Services. As a reminder, all participants' lines will be in listen-only mode, and there will be an opportunity for you to ask questions at the end of today's presentation. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I would like to hand the conference over to Mr. Sabri Hazarika from Emkay Global Financial Services. Thank you, and over to you, sir.
Yeah, thanks, Sejala, and good afternoon, everyone. On behalf of Emkay Global Financial Services, I welcome you all to the Q4 and FY24 post-earnings conference call of Gulf Oil Lubricants India Limited. We have with us the top management of the company, Mr. Ravi Chawla, Managing Director and CEO, and Mr. Manish Kumar Gangwal, Chief Financial Officer. So without any further delay, I would now ask the management for the opening remarks, and then we'll move over to the question and answer round. Over to you, sir.
Thank you, Sabri. Good morning, good day to everybody. Thank you for joining us on the Q4 call. We are very happy to share with you that this has been a record-breaking quarter for us in terms of our results and our achievements. It's definitely an excellent quarter. We've maintained our growth momentum, and this is the third quarter in a row where we've crossed our EBITDA of 100 crores. In fact, 115 crores is the highest EBITDA for the company ever. So a strong quarter end, as March is expected to be with all our programs and our initiatives going on. So really happy about that. To add here, obviously, that our EBITDA margins sequentially went up 13.5%, tracking towards the higher band, which we talk about 12 to 14%. Definitely margin management efforts, increased focus on cost and focus on premium products helped us to get us there. So these were the highlights. The growth has been majorly driven by a lot of double-digit volume growth in infra and B2B. As a press release we have released. Overall, of course, our B2C sale also showed very good growth, and in the quarter, and good uptick in the motorcycle oils, the commercial vehicle oils, and agri segment, which is really beginning to show a good demand across, as you are seeing in other industries also, rural demand is picking up, and we have seen that also happening in March and then continuing. We've also seen that it's been obviously, if you look at the annual performance, we've seen our EBITDA crossing the 400 crore mark, reaching 419 crores, growth of 22%. And definitely that's a good sign for us. We've also seen a lot of good gain in market share overall in the year, with our bazaar segment growing, led by agri and new generation commercial vehicle oils. Happy to also share that our car stops and bike stops, which is a key initiative for us, have also experienced strong double-digit volume growth in terms of secondary sales. And overall, our distribution focus and distribution in retail segment has paid off. We've grown double-digit in that, both in rural and urban areas. So overall, annually and the quarter, I would say very satisfying year that has happened. And in terms of volumes, we have closed the year with 2x the market growth. And in the quarter also, happy to share, we have achieved 37,000 KL in core loops. And of course, we also have the highest in AdBlue this year, where we did 37,000 in AdBlue. So both combined 37 and 37, coincidentally the same figure for both. While the growth overall is 3% in the quarter, because factory fill, as we've been sharing, has dropped by double digit, and I think that's more due to the production for OEMs. Without the factory fill, our 2x market growth has been 7% in the quarter, and in the year also we are close to that 6.5%. So I would say that 2 to 3x mantra which we have in terms of market growth we have maintained. So a good quarter again, once again, led by a lot of investments in the brand, continued push in terms of all our businesses, B2B, B2C. We are also doing a lot of digitization, other efforts. I'll now hand over to Manish to take you through some of the other details which you can highlight. Over to you, Manish.
Thank you, Ravi. Good afternoon, everyone. Yeah, as Ravi highlighted, it's been a very good quarter for us, all-round performance. And of course, our profit after tax on the back of a solid EBITDA has risen by 37% to 85 crore. And also for the full year, the profit after tax is 308 crore, which is again 33% growth nearly on a full year basis as well. So overall, very good year and quarter from PAT perspective. At the same time, our margin management, as Ravi was highlighting, has been robust, and we have improved our gross margins by nearly 3.5% over the year. And sequentially, we see a slight dip because the crude was volatile during Q4, and we have seen nearly a 1.6% drop on the gross margin level sequentially, but we have been able to deliver the same EBITDA, almost 13.5% for the quarter, in spite of the slight dip in the gross margins. That is, having said that, we have always been focusing on margin management. So all the actions are already being taken to continue to be robust on the margin management side. We have announced the price increase in our retail segment just now, and also in certain B2B segments we are taking the prices up already. So that is on the margin management. A very robust cash generation from operations, 348 crore of cash during the financial year generated out of operations versus 273 crore last year. So very healthy cash generation continues with effective working capital management and overall delivery by EBITDA. And based on this cash flow generation and the profitability, the board has been very happy to announce a higher payout and the final dividend of 1,000%, which is 20 rupees per share. You will all recall that we have just in February paid an interim dividend of 16 rupees. So with that, the overall dividend for the year is 36 rupees, which is 1800% on a face value of 2 rupees. So overall, I think the journey on returning good cash to shareholders continues with a higher payout this year. And with that, I think we will be happy to take questions from the participants. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Probal Sen from ICICI Securities. Please go ahead.
Yeah, thank you for the opportunity. Am I clearly audible?
Yes, Mr. Probal.
Yeah, thank you for the opportunity. So congrats on a good set of numbers. I have 3 main questions. One, if we look at the margin scenario right now for this year, what we have done.
May I request you to please use your handset?
Hi, am I not audible?
Yeah, slightly we are not hearing there is some
background
disturbance.
noise, sir. There's some background
Sir, is this better, sir?
Yes.
Absolutely fine. Yeah.
All right. Sir, just first question was regarding the margin environment. Now, if we really go back a little bit and look at the kind of margins we earned over FY16 through to FY21, just wanted to understand, sir, that in the current input price environment and with the kind of pricing we are seeing across our portfolio, what would it actually take for us to go back to that environment, if at all feasible? Is it what I'm trying to get at is a margin improvement to that extent even feasible, or we should look at a more steady state, gradual margin growth over what we have achieved in terms of EBITDA margins this year? That was my first question.
So, yeah, I think, Mr. Probal, I understand where you are coming from. We have been delivering 16% EBITDA margins in the period you mentioned, roughly 16% to even sometimes 17%.
Right, sir. Yeah.
And we have explained in the call earlier also, and for the benefit of everyone on this call, you see the input costs increased during the post-COVID period significantly. And for that, we had to take series of price increases and our realizations went up. while the per liter margin we have been able to recover fully what we were in that period which we are mentioning 5 years ago, the percentage looks lower because you are dividing numerator and denominator by the same amount. So if you take on per liter basis, actually for the core lubes, we have already recovered those margins and we are in the similar band. Secondly, overall for the company as a whole, the margin slightly looks lower because our AdBlue volumes have picked up significantly, which we all understand is a slightly lower margin product. So this is a blended margin as compared to earlier when it was more, mostly 95% plus 98% was only core lubes. So in spite of that, we have been able to deliver this kind of margin in the 12 to 14% guided band. We actually dipped to 11% in one of the quarters, just before, but we have been able to recover from there significantly, and now we are tracking nearly 13.5%. Of course, always there is a premiumization which Ravi talked about, and there are product mix and there are continuous improvements, and there will be an sort of, I would say leveraging effect, operating leverage will also keep coming in, which will help us to move back to the 14-16% band, but that we will have to really, take it as a future target.
Understood, sir. And the second question, of course, was about the volume growth. Now, I think Ravi sir also talked about the fact that volume growth, even in this year, if we take out the factory fill portion, is probably at about 6 to 7%. But on an overall basis, therefore, sir, is it fair to assume that for the next couple of years, given that factory filling will remain a fairly large portion, or at least a material portion of our business, that low to mid single digit growth is what we should be working in on an overall basis? That's more realistic to assume.
No, so basically, factory fill is only 10% of our volumes. So it's not a very significant portion, but if that 10% dips by nearly 20-25%, then we have an overall impact of 2-2.5% on the total volume.
Understood.
But our trajectory, our guidance has been to grow 2 to 3x the market growth, which we have done in the last year as well, and we continue to aim that. So if the market, let's say, gets some tailwind and market grows at 4%, we will definitely aim at a double-digit growth. And if the market is at 3% or 2 to 3%, then high single digit. That's what we are currently aiming at.
Right. The third question was, sir, with respect to, and this obviously gets asked to our company as well as others in this space. In terms of EVs, on the ground, what are our activities right now? Any update you can share with us? And also, if you can kindly share whatever revenue we did from the battery segment for this year, if feasible.
Yeah, so on EV, Mr. Sen, let me mention that the EV fluids business is a very small business, not even half a percent of the volume. But we are with about 10 OEMs now, looking at another 5, 6. So that's going to be continuing our EV fluids journey. And as we are investing in the chargers business in Tyrex, and we've also got Electrify, a software company, we are looking to grow that part with our EV business. And of course, in the battery business, we have done, I think this year we'll be at about 80 crores. And we are looking at toll manufacturing local product and looking to grow that business quite aggressively going forward because a lot of touch points are coming in. And that continues to be part of our Gulf Pride brand extension. So I think we are hoping that, that also grows double digit, and it will. So this is where we are with both these businesses. And just to add to your other point on the what Manish was trying to explain, you see, for us, our mix is B2B and B2C. We as a company are focused on various segments. So in order to maintain the margin and be competitive, we want to grow all the segments that we are focusing on. For example, OEM. For example, industrial. Where our market shares, we have great opportunities, for example, in industrial. OEMs, we are pretty strong. We believe in the private sector, we are amongst the leaders. So that is why our margin band is what it is, because we have to compete and grow. So, that's probably what I want to answer. Yeah. Okay.
If I can just get one last question in, sir. In terms of just the immediate year, in terms of FY25, if I were to talk about our strategic imperatives just for the next 12 months, anything specific you would like to highlight that we should take note of or keep track?
Manish, sorry, can you come again?
Yeah, I didn't get you.
I was just saying, just from a next 12-month perspective for FY25, sir, any specific strategic moves that we should be aware of or we should be keeping track of in terms of our company? Obviously, you've laid out a broad strategic vision in any case for the next few years in terms of how you want to grow. But just for the immediate 12 months, anything specific we should be looking at? Any OEM tie-up, any specific segment growth that we should be looking at? Just wanted to get more of a sense in terms of, how to build a more granular growth for FY25 in particular. Any color you can throw would be useful.
No, I think our core strategy is to get that 2 to 3x growth. Within
Right.
certain segments, we see the opportunity to be greater. So we have some market segments where our market share is about 8-9%, like motorcycle, like commercial vehicles. Even there are opportunities, but there are certain segments where our market share is below 5%, like passenger car. Like
Right.
we have
Right.
in the case of passenger car, in the case of industrial. So these are the segments where we believe we can grow much faster than the 2 to 3x. So I would say that's one call-out. The other is premiumize and offer value products. So both we'll do. And there's a lot of digital efforts happening in the company, which will also fructify in terms of both customer value creation and benefits. So these are the three themes I would call out. And the fourth, of course, very important, which has now become our sixth strategy, is the focus on EV. So both with OEMs for EV fluids, we're also looking at the charger business through Direct. And that's going to be another focus where, we mentioned in the press release that it's been a good, closing for them. So next year we are pretty charged up, so as to use a word in terms of the DC chargers. So we would be looking at a good growth. So I think these are the 4-5 new call-outs.
All right, sir. Great. That is extremely useful. Thank you so much for your time.
Thank you.
Thank you. The next question is from the line of Prakash Kapadia from Spark PMS. Please go ahead.
Yeah, thanks for the opportunity. 2 or 3 questions from my end. For the financial year, out of the approximate 33 billion sales, could you give us some sense of B2B, B2C sales or, industrial and auto, what has been the sales mix and what have been the growth rates? And within auto, if you could help us understand, you mentioned there are certain segments where, market share is low. So how is, CV, passenger, two-wheeler sales mix being for us? And industrial segment, how is, the end users industries for us and what are we trying to focus on?
Yeah. So just to take up a few segments to share with you. So our B2C, what we call is basically the channel bazaar business. We have a set of distributors and we also sell through the franchisee workshops. So that is roughly about 60% of our sale. So around 60% of our volume goes into this segment, which we call B2C, which is more route to market. So obviously they sell different products. The 40% is our B2B, which also has automotive grades, but it basically talks about selling to, the OEM factory fill is like a B2B sale. Then we talk about direct industries and smaller industries. Of course, we have distributor networks, so that we call as B2B. So, and then we have one segment called infrastructure mining, which is only catering to construction companies, which is roughly 8-9% of our volume. And then, of course, we have, other segments like exports and, marine, etc., which we cater to. So if you talk about B2C, B2B, it's 60 B2C, 40 roughly. Yeah, that is how we have 55-60% is B2C, roughly if you see the quarter-wise thing. And then within the segments, if you look at commercial vehicle oils, where we are amongst the top players, we have a very good share in certain geographies. We have a very good share with certain OEMs. So we see a lot of potential in some of the OEMs, some of the geographies, where we may be less than our 8, 9, 10%. So there's an opportunity in each segment, but to call out 2-3 segments very clearly. One is the passenger car motor oils, where we don't have too many OEM tie-ups, but we have a lot of scope because our brand is strong and we want to really grow in that. If we are growing 0.5% market share in our overall or little more than that, we would like to grow at least double of that in passenger car. So passenger car is one call-out segment, including in industrial. There are certain, pockets where our share is low, so we can grow in that. And I would say these are the 2 call-outs. And within certain segments like tractor, some geographies we do less. So I think across the board we have scope to grow in these segments. So overall, that's what our sort of outlook is.
Sure. And if I, understand this correctly, you said, around 40% is B2B. So the industrial would fall across that. And is it fair to say that is growing faster as of now, given the thrust on?
You are right. You are right. That is giving us very good growth. Because also we have got, good products, good. Absolutely right.
And that should grow in the near term, and that should continue to grow slightly faster than the other B2C business, right, in the near term?
Definitely.
Okay. And lastly, what is the kind of CapEx we've done on the EV charging segment till now?
So in December quarter, we acquired a company, which is the name is Tyrex Transmission. They are a OEM for making DC fast chargers, right from 30 kilowatt to 240 kilowatt chargers. And that's 103 crore rupees of investment we had put in that quarter in that company to get 51% share. And we have majority on the board as well. So that company deals in the fast charger space, and they have a series of customers and OEMs and bus OEMs and CPOs who are buying their products. They have more than 800 fast chargers already installed across India and running successfully. So that's one investment we have done. In addition, we have earlier years we have done two more investments. One in a software as a service company called Electrify, and another one was in a AC slow charger company, which is a UK-based company, which is a very advanced technology based AC slow charger company. There we have some 7.5% stake. So overall, I think from Gulf India balance sheet, we have put in nearly 150 crore rupees in these three investments so far in the EV segment.
Understood. And that over a period of time, we seem pretty optimistic about the potential. And I think in the opening remarks, you mentioned around 80 crores was the EV fluid plus EV charging revenue, right? Or that was just EV fluid?
No. 80 crores was battery business. EV fluids is a very small part as the volume is also low. We have 10 OEMs. So EV fluids is quite small. Of course, in the case of DC chargers, Tyrex currently has about 8-10% market share. So based on how big the market can grow in DC chargers, we'll be looking at obviously keeping our market share and trying to obviously optimize that.
Okay. Fine. Understood. Thank you.
Thank you, sir.
Thank you. The next question is from the line of Nitin Tiwari from Phillip Capital. Please go ahead.
Good evening, sir. Thanks for the opportunity. Just a few clarificatory questions from my end, sir. So, sir, in this quarter, our gross margins on a sequential basis is on the lower side. So, in the previous quarter, we did about 42.5%. This quarter, it's about 41%, but we have maintained EBITDA. So is it right to understand that in this quarter there were fewer promotional and BTL activities, and probably we are reaping some benefits out of the activities which we undertook in the previous quarter? So that would be one. And related to that, if you could help us understand the ad and the BTL sort of promotional expenditure as a percentage of top line, if you could help us understand that first, and then I'll ask the rest later.
Yeah, so you're right. Sequentially, the gross margins are lower by nearly 1.5%, and around 50 basis point is the lower NP. Last quarter, we mentioned that we had a slightly, higher NP in the previous quarter. So around 50 basis point from there, and rest is from the overall other cost and all. So yes, in spite of the slight sequential dip in the gross margins, because the raw material cost and tracking crude, the base oil were at a slightly elevated level, we have been able to deliver 13.5% EBITDA. Yeah.
Secondly, sir, on the pricing front, can you help us understand abroad, basically, abroad level is fine in terms of where our headline prices are for lubricants right now and for AdBlue, and what kind of increase that we have taken in this quarter that you mentioned earlier in the call that you've taken an increase. So where the prices are and what kind of percentage increase we would have taken? A broad level understanding would just be fine, sir.
So, see, overall on the realization side, if you talk about, and just to mention on the margin side also that, this quarter the AdBlue has been sequentially higher. So last year, this December quarter, the AdBlue volume was around 31,000, and this quarter was 37,000 KL. So in spite of an higher AdBlue contribution, our margins are maintained, or the dip is only 1.6%. So you can understand that there is an improvement in the overall core lubricant side in terms of that. And at the same time, whenever the cost goes up in the retail segment, we are in a position to, pass it on to the end customer consumers. We have to take certain adjustments to the scheme or price increases. And we have just recently taken a price increase in the retail segment. And in B2B segment, it is a matter of, negotiations and approaching each customer and convincing them. OEMs, which is a good part of our business, there are price variation clauses which help us maintain our margin.
So, sir, I was just trying to understand a broad percentage increase that we would have taken. And is this the first increase that we have taken in this year?
Yeah. So we have not taken any price increases in the retail segment in the last 12-15 months. So this is after a gap of almost 12 months that this price increase is coming. Percentage will be difficult to tell because it is different across different product categories, depending on the market and competition.
Fair enough. And so lastly, if you could just help break down the sales in terms of sales mix in terms of motorcycle oils and PCMO and CV, a sort of a slightly detailed mix would be helpful, sir.
So in this quarter, it was mostly the same as the December quarter. In terms of overall percentages, around 38-39% in terms of diesel engine oil, nearly 20% in terms of personal mobility, and industrials are also around 20%, and the rest is the others, which is gear oil, greases, and others.
Sorry, personal mobility you said is about 20%, is it?
Yeah.
Which includes both motorcycle and car oils?
Yes.
Understood, sir. Thank you so much, sir. I'll get back in the queue.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your question to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Arko Pratim Pal from Sanjay Agrawal Broking. Please go ahead.
Good evening, everyone. Am I audible?
Yes, sir, you're audible.
Thank you. First of all, congratulations on achieving a significant result. I would like to know what is your corresponding volume growth rate, and additionally, how will product pricing adjust to impact volume growth? Could you please share your projection for volume growth in current quarter?
One is your audio is slightly weak, and second is we could not understand what the actual question is.
Am I clear? Am I audible now?
Sir, may I request you to use your handset, please?
Yeah, I am on my handset.
So can you come near to your mic and speak,
Slightly
please?
louder.
Yeah, sure. Am I audible now?
Yeah, better.
Yeah. I'm talking that congratulations on achieving a significant result. I would like to know that what is your corresponding volume growth rate in terms of product volume growth rate, and additionally, is there any price increase or decrease that can be impact your volume growth?
So we have already, mentioned our volume growth for the quarter and for the full year. Mm-hmm. Excluding factory fill, our volume growth is 7% nearly for the quarter, and for the full year nearly 6%. And second question is basically that whether the price increases impact your volume. Is that the right question? Right way to understand your question?
Yes.
So this is a semi-essential product. So of course it has to be used after a certain interval. People have to change oil in their vehicle, and industries also have to use it. But obviously, if there is a significant price increase, then there is maybe a tendency to shift towards lower value products in some categories. But typically, it's not a very price elastic sort of product category.
Yeah. Just to add here, you see, when you look at a particular brand and a product which has a certain technical specification, the product laddering for us works in strength of our brand, our distribution. So once we have that, I guess we are clear about our price positioning. Yes, if you do take your prices up above that positioning, then you might lose customers. And similarly, if you are very aggressive, you want customers, you've got to go. So we have, I think Gulf has a certain place in the market with the brand strength, and we are number 2 in terms of our brand